And good afternoon, everybody, and thanks for joining us for the Horowitz Company pop-up Q&A webinar for July 20th, 2020. It's been a week since we last met, and a lot has happened. Basically, we're in the heart of earnings season, or getting right into the heart of earnings season, as we saw many of the financials reporting last week. One of the things I saw just tonight, by the way, was the report from Hibbett Sports. And one of the things that I thought was really interesting was they had a monster beat both in-store, online, big numbers. And what really made me feel good about that in a very weird way was maybe we're getting back to some of the things that we used to do, whereas technology and TV and other things got in the way of just basic sports and maybe even getting together with the family for dinners. I bet you barbecue sales are on fire, and I bet you that other things that we used to do that really took for granted, no longer do anymore, have really come back in a big way. So maybe this is a social reset in a different way that maybe it's kind of good. So it's just something to think about. Before we get any further, let's mention that this is for educational purposes only. There is no specific recommendations on stocks, ETFs, or anything else that we're really going to talk about. So if you have questions on that, we'll hold that off to another time. Of course, any questions that you want to ask, though, are welcome. Any size, any way, any look, anything at all is welcome to be asked. This is your opportunity to spend some time, and we'll do our best to give you those answers. But again, this is just for educational purposes only. It's not a recommendation to buy or sell any security at all. So, as I mentioned, we had earnings season start up last week with the banks. The banks reported, and as we usually see, there's a lot of excitement going into that and the notion that hopefully banks will do well. And as you know, if you heard me talk about before, one of the big things related to the banks and the markets, maybe not so much this time because it's a different environment, but you have to have the banks participating to get the feeling that there is a bullish sentiment out there for the markets. And the reason for that is that basically every financial institution, hedge fund, mutual fund, institutional investor love the financials. They're a cash cow. So essentially what we have is a situation that if you can't get anybody interested in the financials, what could they be possibly interested in? Well, right now it's technology. We know that. But with the banks moving last week, we saw a bit of a rotation, some better news on some banks, and other banks not so much. The smaller players are going to be starting to come in this week with some tech. We saw IBM tonight. We'll see Netflix this week as well. Some industrials coming out as well. There has been, I guess we could summarize the bank earnings as this, that there were huge loan loss provisions that were added back pretty much to every single bank out there. However, that really hits the banks that primarily do mortgages and do consumer lending. The banks that have more of an investment banking side to them did pretty well. In fact, we saw that JP Morgan and Goldman Sachs and Morgan Stanley all had standout numbers because what we saw was that they were able to turn the stimulus program and the restructuring of debt and the money from the Fed into revenues on their books. Not to mention all the money, the billions of dollars they made in fees on the PPP program. So if you've been listening to what we've been talking about, we've been saying that all this stimulus and the PPP program and a lot of the other things that are going on are in a way a backdoor bailout for the banks. We need the banks to be solid. It is clearly the plumbing of our economic situation here and around the world. We need the U.S. banks to be strong. So the Fed was doing everything they could to, at the same time, lower rates for people out there, but also it is important for the banks to do well on their own and have a lot of, I would say, status and good health of their financials. So on one hand, as they were lowering rates and the yield curve was flattening out, while that's not good for the banks, there was something else that they did to help out the banks on the other end. So what we're seeing is those banks did pretty well after earnings because the fixed income component and their trading did very well through the quarter. Again, thanks to the Fed for providing that opportunity for them to have that record number of debt issuance for companies and provided a great deal of revenues in the form of fees on those restructurings as well as the debt issuance. On the other hand, we have banks that are not doing so well, primarily the banks that don't do investment banking or trading. Those banks that don't have that, you look at a Wells Fargo, pretty much at a reaction low, the lowest point they've been all year, pretty much hit today. So other banks that have less of the investment exposure or the investment banking exposure or the fixed income trading exposure are not doing very well. It is not the environment for banks right now. As we have near record unemployment, as we have a yield curve that is flat, low interest rates, we have a housing market that on one end is doing well for single family homes in the rural areas, but yet in the suburbs, primarily, and in city centers, not so much. And the question about, office buildings and new loans for creation of offices, not really something that is going to benefit them in this kind of environment. So this is where the rubber meets the road, right? This is going to be the names that are holding up the market over the next couple of weeks. The Microsoft's, Amazon was up really big today, which was helping out the NASDAQ dramatically. As a matter of fact, the move on NASDAQ on Amazon today was over 50 basis points, almost 0.6% of the NASDAQ's over 2% return for the day today. The NASDAQ, which was very soft last week, there was a lot of selling going into the end of the month option expiration. And we saw that Amazon was down 12% from their high, and we saw things like Netflix on their earnings fall down. We saw Tesla taking a bit of a tumble. All the names that had been going well, the Pelotons and all that, really sold off last week. They made it all back today. Peloton up 10% today, Amazon up 7% today, Microsoft 3% or so today, Apple was up again today. So this is really important for the market because right now technology, the technology sector holds about a 30% total exposure in the S&P 500. Banks aren't as important anymore. Healthcare is. Consumer discretionary. Energy is not. We have flipped from where we were, let's say, a couple of decades ago to where we are now, where energy was a major component years ago. Industrials were a major component. Not anymore. What we're seeing is that technology is the biggest one. So we're going to have to, hopefully that the numbers that are going to come out over the next few weeks with regard to technology earnings and outlook is not going to be a problem. Hopefully what we're going to see is that there is a significant amount of earnings that meet the anticipation of where stock prices are right now. But probably, that said, not much is going to matter. Markets are setting themselves up in a way for disappointment to a degree, the thinking is, not the price, the price action, but the thinking is, they're probably going to disappoint. They're probably going to have a rough outlook moving forward. So they're set for that. And they're probably willing to give companies a pass, as we've seen, because you know what? We are in some terrible times, but yet they're seeing that the advancement of technology over the last 3 or 4 months has been the equivalent of what we've seen in like 2 or 3 years. They've compressed that cycle down dramatically due to the fact of adoption of much of this technology over the last several months as people are needing it more than ever. The other thing that's going on right now in markets is the hope for progress in the area of the vaccine. And we've seen this in the spotlight dramatically last week, where last Monday, Moderna, which has been a name that has been very important in the area of vaccines because they've been promoting the idea that they have something, even though they've never put out a product, even though there's a lot of question as to are they going to make it happen, and some skepticism around their results due to the fact that they've had a very small pool of people that are testing this. The participants are, numbering 35 in these tests. That's not normal. Usually a lot bigger of a test, but yet their test did come back and their study did come back that all 100% of the people in the study did produce antibodies, the ones they were looking for COVID-19. That really helped the markets last week dramatically, and one of the reasons why we saw some of that turn, because as we see that we're getting back to quote unquote normal, whatever that means in the future right now, but at least closer to where we were in the past. That normalcy that we had, that some of the names are going to sell off because, you know what, maybe they're going to go back to the gyms and not use the Peloton. Maybe people will go back to face-to-face meetings to a degree, not utilize the Zoom medias, technology for video conferencing. Maybe they're going to start using fuel again and driving more. So all these things turned dramatically last week. Cruise lines were up 20% on Monday on the Moderna news. Airlines were just really doing very well. And when we have the opportunity to potentially go back to this level of normalcy pre-COVID, and that's out of our minds, and we can kind of move forward where we're not all pinned down as much as we are, and looking at these numbers of 10, 15, 20,000 new cases per state, hospitalizations rising. Miami is at 127% of ICU beds. And what we're seeing around the country in Texas and Arizona and California and Georgia and areas throughout the country where we're seeing spikes and the potential talk of another shutdown or pullback on these phased recoveries, there is the potential for there to be a significant opportunity in these other areas. Now, mind you, right after those stocks went up, they started to kind of level off. Cruise lines fell due to the fact that the clampdown on sailings has been extended, I believe, till September 30th. So they keep on extending the whole sailing issue. And that is creating aggravation in that space because they're burning, what is it they're burning? $60 million a month, I think it is, or some ridiculous number for Carnival. So what we're seeing right now is a kind of whipsawing back and forth, even today. There was better news today from AstraZeneca. We were waiting on these results on their test with Oxford University, and they came out, and it seems like that particular vaccine has a little bit more efficiency because it helps to create not only the antibodies, but keep them in your body a longer period of time. That's the study that came out today. AstraZeneca was up before this, came down about 3% today. And we're making progress. We're making progress at historical speeds. But even if there is a vaccine available, when is it? By the end of the year? What happens from now till then? For the first time, maybe the second time, or maybe I'll give it third time. President Trump today, midday, tweeted a picture of himself with a mask on. So maybe either one, things are a lot worse than they're letting on to, or two, at least there is some consideration from the government saying, you know what, let's at least try to knock this thing down. Let's put the masks on. Even if they're only 10% or 20% effective, encourage people to wear these and therefore maybe get this thing under control. Whatever your viewpoint is on masks and whatever it is, it doesn't matter. But if there is a chance that there is the potential for them to at least protect either the other person that you're near or yourself, I don't know, it makes sense to me to wear it. But we are seeing that areas around the country are hot spots, and many of the politicians not willing, especially this close to an election, to do anything about them. Not going to shut down the economy, hope that people are going to do what's in their best interest, because there is no major political will to do so. But there is the potential for a self-shutdown. There is a potential for consumers to say, you know what, hey, we're going to do this on our own, pull back, not go out. Maybe not in a coordinated fashion, but individually. People, especially in the high-risk group, will say over 50. That group may say, you know what, and they're big spenders. By the way, the over 50 bracket from 50 to 60, 65 are big spenders. Maybe they may say, you know what, we're going to hold off for a little while. So one of the things we have right now is, again, a lot of questions, not a lot of answers. Let's be honest about that. And some recent questions about the markets I think were really interesting. I got a recent question that came in, and the question was pretty basic. It says, you know, when is the time to get bullish? I think there's a couple of different answers to this. First one, it depends on your time horizon, right? Because valuations will matter eventually. Clarification of the direction of the pandemic will matter. These things will matter. Right now, markets are full of liquidity. Money is pouring in from central banks around the world. People that are at home are thinking, hey, this is a great game. They keep going up. The momentum trade is really doing very well. But yet the question is going to remain, how far can we stretch these valuations, even with interest rates near zero? The second thing is stimulus. What does it look like? Are consumers going to have money? I mean, we are talking about a cliff. That's $600 per week of that special amount that was being paid by the federal government for unemployed workers, which amount to what? Over 10 million still are getting this $600 per week, possibly 60 to 70% of them making more than they made prior to getting this. In other words, in their quote unquote regular job. What is going to happen if that is cut, and what is it going to look like moving forward? Number three, the election. There's been talk about a Democratic sweep. There's supposedly in some polls like a 15-point spread in favor of Joe Biden right now, without him even picking a vice president. Now, we've seen this before. As you get close to the election, there's a lot of talk from various parties that we have this big sweep. We're going to have the incumbent is going to lose and all this. And they talk about the economy. Obviously, the Trump administration is doing everything that they can in order to provide stimulus and, keep themselves in office to make people very happy. That's what happens time and time again. This is just a way that this works. The incumbent will do everything they can in their power up until the point of the election to get in. And it's obviously the job of the other party to do what they can to either discredit or to come up with a better plan. We don't know what the Biden plan is because you know why? Very simple. There hasn't been one. There's been some talk here and there. But let's be honest, there's not a lot of plans from either party right now except for, well, we're going to stimulate, we're going to pay this, we're going to pay that, we're going to bring up this money. It's all about pushing money out into there right now. Really no concerted effort on a major platform plan by either party. So what can we get bullish on? What areas maybe have been, I would say, not picked up value and maybe are even a valuation, have a better valuation. Things like emerging markets. Non-U.S. looks a lot better than the U.S. Now you may say, well, they're not doing so well. Well, if you want to use the virus as a benchmark, we're a lot worse. They're far beyond us in Europe and Asia and China. And you may say, well, they're lying. Well, whatever the numbers are, we have to believe something. And it does look like they are doing a lot better in other countries. Maybe don't have as much stimulus right now, but also we're not going to have the stimulus choke when ours comes out compared to what's happening there because they're making it through this a lot better than we are. Value. Again, we saw a taste of it last week where value beat growth dramatically. If, in fact, we have any semblance of going back to where we were before all this, sometime in the future. Listen, don't we all know eventually this is going to pass? Now, it's going to either be very painful through the process if we don't get our acts together, state by state, county by county, federal government. Yeah, it's going to be really difficult. But eventually it's going to pass. Even during the 1918 pandemic, even during SARS, the Ebola outbreak, MERS, bird flu, these pass. And there's a lot of money right now in the system. So I think it's going to be kind of interesting. One of the things I want to show you here, if you look at your screens for a second here, is, and we just wrote about this, and we sent this out to our clients, and it's this idea of, bear markets. Which one's a good one? Which one's a bad one? And when you look at this chart, let's start with what this is showing us. It's showing us three different and distinct types of bear markets, maybe even recessions, just downturns in the economy, downturns in the markets. Basically, this is structural. Structural is pretty much when you have a breakdown of a sector that is very important to the markets. So, for example, clearly we could show that 2008, 2009, with the financial crisis, banks were over-leveraged, people were over-leveraged. It was the real estate market primarily, but a big chunk of that really had its tentacles in all sorts of areas of the economy. And that structural is a really bad one. It takes a very, very long time because we see an average decline of about 57%. We see the average length is about 42%. And we see the average time to recover in months is about 111 months, which is, from 2008, that pretty much does tell the story. It was about an 8-year recovery time to get things back to where we were. Now, employment situation picks up a little faster. Maybe the markets can pick up a little bit, but generally, depending on where we are, the depth of it and what it was and why it was is all about, the time to recovery. But this is the averages over time. There's not a lot of bear markets and recessions compared to expansions, but this is what we have seen historically. Now, there's cyclical. When we look at cyclical, that's a little bit different. Cyclical is more so when you have a situation where there's been a long-term overall economic expansion and then things get a little bit wonky, right? Because now all of a sudden things start to slow down more naturally. It's a cyclical event. And basically we look back to the 70s and 80s and when the Fed jacked up interest rates to 20% because inflation was hitting hard and it turned things around dramatically. That was pretty much the poster child for a cyclical market, bear market situation. Those are about 31% top to bottom, cyclical about 27 months to recover, 50 months for average recovery time. Now, event-driven, that could be like wars. That could be what we're seeing right now, which is an unbeknownst to anyone, out of the blue, nowhere to be found. All of a sudden, wham, you got a pandemic. You got maybe even a tornado or a hurricane or an earthquake. These have an average decline at 29%. Now, the last one from top to bottom is about 35% on the S&P 500. Now, here's what's interesting. The average time that this goes on is about 9 months, and average time to recovery is about 15 months. Now, so far in this particular circumstance, because the fire hose was opened up wide from a stimulus standpoint, what do we have? We have like a 3-month recovery time, maybe 4. Now, the S&P just turned positive again. It's right on the positive side. The NASDAQ is positive dramatically for the year, up 20% approximately. And the Dow Jones is still down for the year, down about 6.5%. But what we're seeing is a major recovery time, not from an economic standpoint yet, clearly not. We haven't even got the numbers, the true numbers yet for the second quarter GDP. It hasn't come out yet. So right now we're still in it. We're still in it. But this is kind of cool. The other thing to look at is on average, just to know that expansions last about 3 times longer than recessions. If we look at the average recession in time, we look at the expansions last about 47 months. Now, we're just coming off of this. We're finally done with this official expansion that was the longest in history at 129 months, if you count from where we were in about 2009, 2010. Recovery starts of that cycle into where we were, we'll say February high, maybe January high, before the official determination that we entered a recession in the latter part of February into March. So right now we are in a recessionary time. How long is it going to last? I mean, right now it looks like it's going to last maybe 4 months, 5 months. Much lower than the average recession. And the reason is, again, because it was very quick acting fiscal and monetary policy that was put together, worked together in a way that was substantial. Much more than ever before in terms of size and breadth. And yeah, a lot of people got a lot of money that shouldn't have gotten money. Fact remains that it did clog the hole in the boat because it was sinking. It still is sinking. And if it wasn't for that, a lot of people would have lost their houses by now. If it wasn't for the moratorium on mortgage payments, if you chose not to pay your mortgage, you had like 4 months that you didn't have to pay your mortgage. Now, again, a lot of this has to be looked at again with what is coming down the pike, which is said to be anywhere from $1 trillion to $1.5 trillion of new money that's going to be utilized on a fiscal basis for stimulus. And what that's going to be and how it looks after it goes through the sausage factory is anyone's guess. But right now what we have is more that's coming. So all of this together has clogged that hole, or patched the hole, at least temporarily. When you pull that patch off, hopefully the boat is going to be above water because there's going to be a time the stimulus has to stop or paid back somehow, some way. We're talking about an excess of about $7 trillion right now. Massive. All right, well, those are my comments opening on this Monday, the 20th of July. Let me mention that hopefully everyone that you know is doing well and that you're staying safe, staying sane at the same time, which is important. and trying to keep the weight off. I got what they call the COVID-15 going on through all of this, doing a lot of smoked meats and barbecues and eating at home, getting deliveries and making the food. So hopefully you're doing well and your family's doing well. Please do me a favor. Any questions that you have, put them into the Q&A panel. Let me just look here. We have a good amount in here. Some nice good afternoons. Thank you, Larry. Okay. I'm going to answer a question that came into the chat by accident from Aaron. He said, I'm interested in two things. Oh, by the way, I'm going to mention this again. Any question you have, no matter how simple you think it is and how maybe insignificant it may be, ask it. Put it into the Q&A. We'll get through it. Okay, Aaron says, I'm interested in two things. Your opinion on the long-term investment opportunities for brokers like E-Trade or Schwab and Morgan Stanley with adding of a trading platform, and your opinion on Noble Energy purchasing Chevron. I have positions in Canada already. So you listen, let's start with the latter. There was an announcement today that Chevron is going to be buying Noble Energy. Obviously, there's going to be a lot of consolidation in the industry after what we saw, which still is an extensive, massive amount of losses by many in the sector after we saw that crude oil drop so substantially during last quarter. I mean, the crude is what now? About $40 a barrel. Some of the frackers, some of the distributors, some of the areas that can't make money, some of the companies that can't make money under a certain amount, whatever that particular level is for crude oil, it's going to have a lot of problems. And what it does is it creates a great opportunity for those companies that have cash on hand or have the ability to utilize their stock to buy some of these companies, to integrate into what they do and to clean it all up because they're pretty much on sale. And with those kind of things, it really works out very nicely. We've seen this before, and we'll see it again. You're going to see a lot of consolidation, a lot of M&A activity, and there's going to be a tremendous amount across a lot of different sectors moving forward. Because there are the haves and have-nots in all of these, and what we're seeing is that the haves are really in a great position right now, and the have-nots are not. And they get the opportunity to buy things on the cheap. Now, you remember back in 2009 when housing was on sale, and there were those people that had money and could scoop up a lot of the real estate that was out there, made a mint on it. Now, for some people, it was a little bit too aggressive, too risky. But when we look at these kind of situations where you have such a major amount of potential for bankruptcy or companies that just can't make money in the environment, and those companies that have money that are flush have an opportunity. So I think that is it going to be good? Is it going to be bad? I can't really give you an opinion on that. The energy space is going to be under a lot of pressure for a long period of time, as long as crude oil stays below this, and not only that. As there is less demand due to people changing their way of doing things. What we really have to do is go back to quote unquote normal. We need airlines to be flying. We need cruise ships to be flying. We need trucks to be trucking. We need trains, planes, automobiles, the whole thing. Everybody going back to work, vacationing, doing all the things that they usually do for us to really kick up the price, because we've seen an unrelenting amount of constraint by people, and the fact is a build on inventory. So it's a big problem. The second thing was brokers like E-Trade, Schwab, and Morgan Stanley. So those brokers, they're making money. Even though there's not any commissions on many of these companies anymore for buying and selling stocks and ETFs, they're making money. Another area of consolidation. You saw Schwab buying TD Ameritrade. You've seen consolidation with many other companies in this area because it basically took prices down to zero. The survivors will do very well. They'll do very well because they make money on a lot of things. What we need to see in this area is interest rates going higher. A lot of the money that these brokers make is on the cash sitting in their accounts, and they can't do so right now. With interest rates as low as they are, they have a really big problem making money on the cash sitting in cash accounts in money markets, which is the bread and butter, aside from trading and aside from their various fees that they have for mutual funds and ETFs. So one of the things you have to see is, long term, if these companies can do well in this kind of environment and they get the consolidation, the possibility when interest rates go up, they could do very well. All right, next question is from Douglas. Douglas says, why do folks discuss the current stimulus as a percentage of GDP? What am I to take away from this discussion? I'm not sure if I should be worried or not. Don't worry, Douglas. Here's why they do it. Right now, the estimate is about the stimulus about 30% of GDP. Why is that important? Well, if you think about, we pretty much dropped the bottom out of anything at all in terms of growth, production, manufacturing, buying for many areas, and we saw a drop of about 40% on an annualized basis in the second quarter. That's what the expectation is going to be. Whether 30%, 40%, whatever that number is pretty substantial. Assume that we take an entire quarter out of GDP. Just wipe it out. Gone. Well, and there's 4 quarters. If we have 30% of GDP that was provided by stimulus, that is enough to plug that hole so that we could say that, you know what, at least there was that much put back into the economy. Now, some of that will slip into different areas. You're not going to see that really pushed right directly into the economy. But I think people look at it because they want to look at how much of that hole has been patched. And when they look at the percentage of GDP, we could say that, hey, you know what, about a third of the GDP has been replaced by stimulus. And therefore, what we can expect is that companies, if we didn't have this, think about where earnings would be. As bad as they are right now, you know, probably approaching, I don't know, 130, 140 for the S&P 500 per share, $140 per share, probably $130 per share for the S&P 500 for 2020. Expectations to be 150, 160 maybe for 2021, getting back to the all-time highs back in 2022. When you think about the amount of money that was pumped in that replaced the GDP, people feel a lot better about the fact that there was some money that came into the economy, and therefore that percentage helps to define how much it is. On the other hand, that's a lot of money. I mean, 30% of GDP is enormous. And as such, you have to think about this as, you know, when's that payback going to happen? Hope that helps with that. Question, do you believe in the rule of 40 as it relates to valuing the high-flying SaaS, SaaS, which is software as a service stocks? Can you explain the rule of 40 for those of us who don't quite follow what we're reading online? So essentially the rule of 40 on 40. Basically it says it is the idea that a software company should have a combined growth rate of and profit margin, and it should exceed 40%. So your profit margin should be 20, your growth rate should be 20, you add them together and you should combine them, you have 40%. This is something that, you know, people are looking at as a guidepost. Because if you have margins of at least, let's say, again, I'm using 20%, and growth of 20%, well, the good news is that that will give you another metric to look at from the area of how to value these companies. And anything that's above that could be, you know, valued lower. It's kind of like the PEG ratio in a weird way. It looks at your growth and it looks at your PE ratio, combines it. It's just another ratio that used in this area of software and technology stocks and SaaS. To look for if there is going to be a good value there and if the company has a sustainable overall program to make money long term. Doug asks, what do you make of the new highs in gold? Is this the inflation hedge play I've been hearing about with regards to stimulus? And he follows it up with relating to the previous question I just asked, what is the deflation? Why is deflation bad, but small amounts of inflation good? So yeah, I think there is the idea that gold is moving up in dollar terms due to the fact that there is a lot of stimulus and we're seeing the dollar come down dramatically. There's going to be more stimulus. The United States is weak. The fact is the United States is not only weak, but we also have this ongoing pandemic that doesn't seem to be letting up at all. And therefore, the idea there'll be more stimulus into the future. So the go-to play for where do I want to be if I think that stocks are highly valued and I don't really want to be there, if I think there's going to be possibly inflation in the future due to all this stimulus, and we just saw an inflation print last week of over 6% on a year-over-year basis, which we talked about, I think, last week, not as bad as it looks because it's picking up from the 8% drop we saw before that. So you have to average that out a little bit and you get back to kind of a normal line. So the go-to place is where? I mean, where are you going to invest? You can invest in bonds. You can't make any money in bonds right now, and bonds are high priced too. So the thought is, if you have a debasement of money, of the dollar, of the currency in a country, and that's being utilized as a way to help growth, a hard asset like silver or gold, palladium, platinum is an interesting play. And that's why we're seeing gold at relatively, I don't know, 8-year highs or something like that. The second question you have is really interesting because this is an ongoing question. If you think about it, it doesn't make a lot of sense. Why is deflation bad, but small amounts of inflation good? So let me start with why deflation is a problem. So if you have big deflation or just deflation, a deflationary environment, what that does is to a degree, it prevents people from making a decision to buy something because they figure, you know what, it's going to be cheaper down the road. If I can, wait to buy gas because I see the prices coming down, let me empty the tank and instead of paying $2 a gallon, I'll pay $1.70. I'll wait. And what does that do? It creates more and more stress because now people aren't utilizing gas. They're waiting to buy it. And what happens is more of a build. And that build causes the inventories to go up. Inventories go up. Well, oil prices go down, gas prices go down, and you're going to kind of continue on that. Think about that. You think about that with houses. Housing prices are coming down. You know what? I'm not going to buy now. I'm going to wait. Or how about this? Let's look at it this way. You go to a store and it says, hey, sale starts on Friday for this product that you want to buy today. And you're like, well, it's only 3 days away. Let me wait. So deflation can create a deflationary spiral, which is really bad for the economy. Now, it's better for you and me. We'll wait. We'll get it cheaper. But it's not good for the economy because what you want for the economy is to have a process where people are like, let me buy this now because I don't want to necessarily wait till the price goes up. And what you have is internally in the process something we call the velocity of money, where we want the velocity of money to be kind of coming in and going out, bringing up price a little bit so everybody makes more money so that it helps out the individual as well as companies and the economy in total. Now, runaway inflation is a problem because it prevents people from buying, right? When things are too costly, you can't buy. But when you have a little bit of inflation, what it does is it creeps prices up over time and people are saying, you know what, I don't need to wait because the price will be a little bit higher in the future. I might as well buy it now. Now, is 2% the right number? I don't know. That's what the Fed seems to think. But it is the reason why they're so terribly fearful of deflation. Next question from Carl. Hey, Andrew, Dr. Copper has been extremely strong of late. This is usually pertains to a strengthening global economy. Do you think the message is the same this time? I think there's been a lot of buying in China. From what I understand, China has been buying it up big. And that is seeing an upswing. But it's also in the same thing we just talked about, the idea of inflation and things will cost more later. Copper is the #1 used metal in industrial production in all sorts of things, whether it's, cars, computers, houses, it's copper everywhere. And until such a time that's not used as that, there is going to be use for it as an indicator of the global economy. And it is, I think, going with the idea that we might as well buy as we saw drop off dramatically a few months ago, and we might as well stock up and pile up. And I think it does, yes, pretend to a strengthening global economy. And how can't you have a strengthening global economy from where we were? So I think people are on board with that. Jojo asks, what is my opinion on the Portland siege? It's ugly. You know what? It's confusing. You see images of people taken away in unmarked cars by people in military outfits, and it's a very strongman position that I find reprehensible. And on the other hand, I think that some of these destructive I'm not talking about the protests are fine, right? As long as as long as it's friendly to a degree. I mean, it could be upsetting, but as long as it stays relatively calm and it doesn't have any destructive capabilities with it. But this Portland thing is I think what it's doing is trying to send a message that you know what? We're really going to tamp down on this and bring in the feds and whoever else involved in a strongman way to quiet this all down because we don't like it. I'm not really in favor of it, clearly, and I think that it sends the wrong message, and I think it's only going to spark more and more disruption. So I don't think that any of this kind of heavy-handedness has any place in the USA. Larry asks, what is the outlook for Lamb in the semis? Hey, Larry, I'm not going to answer that because that is a little bit more very specific. Obviously, the semis have been doing really well. I'll talk about semis. Semis have been doing really well, and there has been an incredible amount of, listen, you work at home, you don't have the right computer, what are you going to do? It's not like you're going to be like, I'll wait. No, you're going to get a computer right away. So you've seen a lot of new home-based computers. Now you say, well, on the other hand, if you're not working from the office, maybe you don't need to buy as many computers for the office. Semiconductors are in everything, right? You have them in portable electronics. You have them in computers. You have them in phones. You have them in tablets. You have them in cars. So, that the semis are looking pretty good right now, especially the ones that are really smart, like an NVIDIA. So I don't want to talk about individual names. But anyway, some of these companies that deal with the autonomous driving, et cetera, are pretty good. Keith asks, what are your suggestions for an average individual investor? There is so much noise and so many suggestions and opinions. We know stock market comes with its profit and risk. How does the average investor plan? So, what's your name? Kavita. So, there's a couple of schools of thought on this, and I think that you need to put a filter on. I go home every night, and we watch the news, and we watch what's happening with the virus. I remember this many times. It's like, how many times do we do this, right? Where, what do you do at night? Well, I'm going to watch the OJ trial. Well, okay. Remember the Iraq War? What are you doing tonight? I'm going to watch the Iraq War. I mean, we have to try our best to differentiate or even filter the noise. That's the word you use, noise. Filter the noise from the reality. First of all, what happens daily, minute by minute in the stock market is noise, unless you're a trader. What happens long-term is really more important. What are your goals? If your goals are, let's say you're 35 or 40 years old. I don't know how old you are, okay? And let's say that you're not going to retire next year, but maybe 20 years from now. Or maybe never retire, but you don't need the money for right now to live off of. You're trying to build wealth. If you're trying to build wealth, what you should do is totally block out the noise. Block out all the things that are happening and understand that companies are uniquely positioned in the U.S. to make money. Companies around the world, what they do is make money. Now, they don't make money all the time, obviously, and you have to pick the winners from the losers. But if you're trying to go broad-based and get diversified, it's probably the best way to do it right now because you don't want to necessarily be in one area versus the other. Our portfolios are really diversified. Sometimes I look at them like, okay, well, we got the international, the large cap, small cap, we got the mid cap, we got the domestic, we have the alternative assets, we have some commodities in there. I'm like, do we want commodities? Commodities haven't been doing well. But we've known over history there are times when commodities are smashingly successful, terrifically profitable. Do I want to take a bet that right now I want to be out of commodities? No, we have a little bit. Maybe we'll expand it if we think the trend is moving in our favor. But yet, I've been talking about this. I'm going to talk about it again. This 1 foot in, 1 foot out. Don't necessarily be all or nothing. If you want to invest, be diversified. Maybe even knock down your risk dramatically so you have a lower exposure to the areas that you're concerned about. But don't necessarily be out of it, because if you're out of it, look at all the opportunity you would have lost over the last 3 months. People that sold out in March. I have people that I've talked to in March and April. I sold out. I don't know when I'm getting back in. I'm waiting for the next leg. I'm like, okay, when's that going to happen? Well, I don't know, but it's going to happen. Well, what are you doing in the meantime? Well, I'm going to stay in cash. Okay, but I'm upset because I'm missing out, but I'm afraid. Well, how does this all work? You can't let your emotions, you got to check that at the emotions at the door when you're talking about investing and this whole line of creating wealth for your future. So our portfolios are set for clients knocked down on risk, 1 foot in, 1 foot out, depending on the client. But if nothing else, knocking down the risk from where they are if they're concerned. So if they're supposed to be, let's say, a moderate risk because of the time frame and their overall risk tolerance, well, we knock it down. Take it down a little bit. This way you don't have to worry about pulling out all your money if things go crazy. So you're not losing as much. Markets go down 30%, you're down 5%. Okay? So I think that there is an opportunity. You don't have to make all the profits on all the stocks out there. Just a good rate of return year over year, compound that over time, and that's where wealth is created. A follow-up question from Kavita. Would you suggest tech stocks for the long term? Again, I think that you're trying to hone in on one specific area, and I think really what you should be doing is spreading the risk over time. Tech stocks look really stretched right now. They may do well for the next few months and all, but it's looking really stretched. Really stretched. Next question. Hi, Andrew. Who's this from? Kwan. Hi, Andrew. Can you explain the correlation between the value of the U.S. dollar and stocks? Do they go up together or inverse of each other, and why? So there used to be a strong correlation with the dollar and stocks years ago, when we were more of a manufacturing country, when we would manufacture and export. So export economies like Japan are very sensitive to the value of their currency. When their currency goes up against other currencies, usually their markets go down because it costs more to buy those products, and the natural procession of the supply chain is going to look for other avenues because of the currency. So if you have a currency that in Japan that goes up 8%, and that product that you're buying, that car, or that washing machine, or whatever they're producing, goes up 8% just on a currency basis, they either have to knock down the price of their product, or you're probably going to go somewhere else and buy the product where it's cheaper. So what happens is that the markets reset on a natural basis. Right now, there really isn't a significant correlation. However, some of the big tech names, some of the big mega cap names, some of the international companies, and some of the multinationals will do better with a lower dollar. We've seen the dollar falling pretty good over the last several weeks. So that could be helping some of the mega caps right now. But generally speaking, in the U.S., I don't think it's as important. Carl, the blowout of government budgets at every level would seem to portend large tax increases will be coming. Do you have a guess to what taxes are likely to increase? In California, we have a Prop 13, which was enacted in 1978, which places limits on the annual increase of property taxes. Well, until they pull that. Do you have any guess as to when the tax will likely increase in California? I have no idea. But you know what? Budgets are problematic. Pension funds for the states are problematic. There's just so much debt they can continue to issue, even though the Fed is buying a lot of it. But there will be a tax increase in the future. And it may be if, in fact, we see that Trump and this Trump administration is not reelected, that the potential for a reversal of corporate taxes back up to 28% or so may be in the cards. And I would assume that there's going to be a need to increase taxes somewhere along the way for many of these states that have terrible budgets and spent incredible amounts of money on this terrible pandemic. Anonymous, why do people say the gaps will be filled, especially in the futures trading? Because they usually are. Usually when you have a gap up or a gap down, you'll see that once that gap and the price gets near that gap again, because there is that gap area that nobody was participating in, there's not a lot of overhead resistance, there's not a lot of support depending on which way the futures or the stock is going. Oftentimes it will fill because it will move vertically through time dramatically on a very quick basis into the gap and fill it. Now, it's not always, gaps aren't always filled. We see a lot of companies have a lot of gaps that just stay that way for a long period of time. But once you look back and you look over the time when there is that gap in a price, oftentimes you'll see that the gap is eventually filled, and when it gets to that gap point, it moves very quickly because of lack of resistance or support. Last question of the day. I hear that high-frequency algos are gaming the markets. Which part of the market are the algos affecting the most? Stocks, ETFs, options, futures? Yes. The overnight is, you see what happens. Most of the play, not today, but most of the play, you'll see the move has been in the overnight markets with the futures. Options, not as much. Stocks, algos know exactly how to level the market, take it up or take it down, dependent on the index. You have a market cap weighted index for the S&P 500 and for the NASDAQ 100. You have a price weighted average for the Dow Jones. That usually happens is you see a big move to the downside of one of the larger price stocks in the Dow Jones Industrial Average. Meanwhile, the Dow Jones Industrial Average is flat on the day, or maybe even up, because they're buying the other stocks inside of that to offset it. So the algos are very smart. Right now, they're in buy mode. They're also forcing the retail players to be effectively having a combo of MOMO and FOMO, momentum needs and FOMO needs, fear of missing out, all in one. So that's kind of what's going on right now. That's the last question of the day. We'll be back again. Well, we have one more. There's a question. How do the algos see our stops and blow us out? There is some talk about, algo, the stop prices are advertised on the systems. And oftentimes you want to set up a stop at the right price, utilizing maybe a limit order as well. That is a problem. I agree. That should be hidden. It should be private. You got to make sure and call up your broker and find out if your stop orders are private or if they are advertised. All right. That is it for today. Everybody, do me a favor. If you have questions, if you need help with your investments, that's what we're here for. I tell you this each and every week, and I want you to have the opportunity just to see what it's all about, how we can help. If you're not a client already, do me a favor. Drop me an email at info@horowitzcode.com. Call us up. I'm here to talk. I will make sure to get back to you personally, and we can talk about your investments, what's going on, and how to make sure that you are set up for your future the best way that you can be. Thanks so much, everybody. Thank you, Doug. Send the email to info@Horowitz, HOROWITZCO.com. Info@HorowitzCO.com. Right on the bottom there, what you're looking at. All right, there we go. Thank you very much. Thank you, Sam. Thank you, Doug. Thank you, Kavita. Thank you, John. A lot of thank yous coming in. Thank you, thank you, thank you. Thank you, everybody. Wow, thank you so much. I will see you again next Monday, or maybe DH Unplugged tomorrow night. Thanks so much.